What's good, everybody? It's Jonah. Come back at another video. So with this video, I'm going to be doing the trade recap breakdown for Monday, July 13th, 2026. And I'm excited to record this video because with this video, I'm going to show you a trick that helped me determine higher time frame bias when trading both the S&P and the NAS 100. So I've hinted at this before. However, this is the perfect day to showcase this because I had to apply this trick. And with this trick, because I figured this out by going through the process, right, of looking at price for weeks and months, right? This trick is what helped me effectively take a successful trade, right? A winning trade. So I'm going to show you guys that today. So jumping in, the first thing we'll look at is Forex Factory. So as you can see, based on the news for the week, right? For Monday, July 13th, we did not have any news, right? Nothing for the red folder or gray folders. So I knew that this was going to be a trading day behind the charts. Now, as you can see for the rest of the week, right? A brief weekly outlook, right? Tuesday, which is today, right? If you look at the bottom right on my calendar, today's Tuesday, right? It is the evening, right? Almost nighttime pretty much. For Tuesday, we were not going to be trading behind the charts because it's this core CPI event, which means I don't trade the day of or the day after CPI. Furthermore, on Wednesday, there's also core PPI. So on this day, I also don't trade because core CPI, you'll see in many cases, typically at the 8:30 mark, there's usually an aggressive candle, either bullish or bearish, right? And that usually wipes out a lot of traders. I don't participate in CPI. I also don't participate in core PPI because normally on these days, at 8:30 there's usually a wick. Price usually wicks on both sides within like a minute or like in a few seconds, and it takes traders out on both sides. So for me, I just don't participate on either of those trading days, and I'll usually wait till later on. So if I provide breakdowns, which I'm definitely going to provide a breakdown for Tuesday, of course Wednesday hasn't happened yet, right? So we'll have to see. But Thursday and Friday I'll actively be behind the charts looking to trade. So I will provide a breakdown for Tuesday. Of course, I didn't trade, but I'm just going to show you guys how my strategy did in fact play out on this day as well, right? So you guys can see that this is something that repeats, right? So jumping into the charts, here we are on the 1 hour. We have the S&P and the NAS. So now the first step is to determine the bias, right? Higher time frame bias. Which direction is price most likely to go? So if we look at the left chart, right, the S&P, right, you'll see first and foremost, right, that price is going up and then down, and then it pushes up and up and up and up and up until it makes its high, right? So at first glance is probably bullish, right? Because you have this high, and prior to this high, what is the most recent swing low that was formed, right? Clear as day, it's this low down here. Now, does this low ever get like traded through or traded under? No, right? Because this low is obviously higher than this low, right? So at first glance, you wouldn't expect that price is bullish for the S&P. However, when you look at the NAS, right, you're seeing that price was in fact bullish, right? Because price is going higher and higher and higher. And this wick right here for this candle makes the highest high. So prior to this high that was formed, where was the most recent swing low that was formed, right? Clearly it was at this level. Now, does this level ever get traded under? And as you can see, the answer is yes, because these low got traded under this low for the NAS. So because this was the most recent structure break or the most recent piece of structure, right? Because this structure break happened at this is the candle from midnight to 1 in the morning, right? So there was a break of structure and a market structure shift at 1 in the morning. This was the most recent structure shift prior to 8:30 in the morning. So as a result, I am going to approach this day with a bearish bias, right? Because I determine my bias using market structure, right? And at least right now, these candles are up until 8 in the morning, but usually I would look from 8:30 to prior to 8:30, right? What is the most recent structure shift that happened? Right here, this was the break of structure bearish. So I am bearish on both pairs, even though the S&P, according to just the chart alone and price action, right, it looks to be bullish because there was no break of structure on the 1 hour. However, the NAS delivered a break of structure lower, So I'm approaching with a bearish higher time frame. Now, if you're someone who also wants additional confirmation, to me that's more than enough to go with that as my bias. If you're someone who's looking for additional piece of confirmation, right? Not only do you have the breakout structure, you also have, right, this gap in the marketplace, right? Price literally gapped, and then which ICT would typically call it a volume imbalance, right? Because there's a legitimate gap in the marketplace, and then you also have a massive wick that traded into the gap and respected the gap. And then here for the S&P, you also have a major fair value gap, which this wick traded inside of, and immediately price repelled away, respecting the gap. So those are your clues of your bias. But to me, I just trade market structure, so that was more than enough for me to go in this day with a sell bias. So because I have a sell bias, I am only looking to take sells, right? Only looking to take sells. The buy button, this blue button that you see at the top left, does not exist because I'm not looking to take any buys, right? I maintain my buys for the entire session. So now we fast forward a few candles just to get up to 8:30. So now this black candle here is the candle that ends at 8:30. Same with the black candle on the right side at 8:30. So now, because we are bearish, right, I am looking for the most recent 15-minute swing high prior to 8:30, so that we can mark that out and have that serve as our liquidity pool, right? So if we look at this candle, this is the 8:30 candle. If I look to the left, the most recent swing high is this candle right here. And the reason for it is because if you look closely, right, look closely, this candle, the top of this candle is higher than the candle to the left and the candle to the right of it. So this would classify as the most recent 15-minute swing high. Now, if you wanted to be extra safe, you could probably put it up here, right, your liquidity pool. But for me, I'm going based on my strategy and my system, and I trust my system because I've seen it played out. So this is basically the high that I'm looking for. So I'll mark this blue because it's buy side liquidity, right? This is the high that I consider to be my point of interest that I want price to attack it, right? Same idea with this on the right side, right? We are bearish. So now I'm looking for the most recent 15-minute swing high to the left of 8:30. And as we can see, it is this high right here. So I marked out my 2 point of interest for both pairs. Now, at this point, I'm also looking at potential targets. So if I'm planning to take price lower, where would be obvious targets, right? Here would be the first obvious target that comes to mind, right? Because this right here is the London low. So this green background right here is just an indicator to tell me like what happened within a certain session, right? Green is London. So this is the swing low, the lowest swing low from London. And the same happens right here, right? This is the lowest swing low, or as you could put it here, right? Technically speaking, right? The London lows, right? Then you also have this low, which is the low of the day, right? You mark out the low of the day for both pairs because those are very achievable targets. And then you can also look to the left, and here you have the massive wick from the day before, which is very close to the low of the day. So this is also a legitimate target for you to reach for, right? So I do all this in advance, right? Before the 9:30 open. I mark all this stuff out before the 9:30 open because that is me planning out my day, my trading session, my trading day, right? I'm sticking with my bias, expecting price to be bearish. So I'm expecting, I would like to see, right? If price is bearish, I want to see price move up, and then when it moves up, break structure, and then make its way all the way down. Because price has a tendency, if price is bearish, it has a tendency to first go up before going down. And vice versa. If price is bullish, price has a tendency to first go down before making the actual move up. So, excuse me. This is what I have marked out. Now, of course, you also have another potential target right here. This is the low of the session because the brown is basically when the New York session starts, the London New York crossover, right? So you have that. So I already have some of my targets marked out. If you want, you could jump into the 5-minute time frame and also look for other targets, right? Because here, right, you can also find fair value gaps, right? So you have uh, right, a tiny fair value gap, right? These are also potential targets that you can take lower as well, right? So you guys are beginning to get the idea as far as the logic and how I plan my trades. So now let's go into price, right? So now you see prices sort of like in a range, and here we at 845. So now we just let price play out. So some of you might have questions of like, Joel, what do you do between 8:30 and 9? Like, what is it that you look for? So I'm not necessarily looking for anything, so to speak, because I'm okay with whatever price does. Because this blue line right here, this is my point of interest, this is my liquidity pool. So you see at 9:01, 9:02 a.m., price purges that liquidity. And to me, that's a good sign because if I'm bearish, I want to see price push up higher because I know price is actively attacking liquidity, right? Price is it attacked this previous high and it's making its way to this previous high. And price has a tendency when it's bearish, right, to go after old highs and then break lower. So I want to see price like this is good. I want to see price make a push up. Now you probably might be thinking, well, Joe, instead of price pushing up, what if price decided to go down lower? Now, it's not ideal, right? Because you want as many of these lower targets to be left alone, right? You want it to be available because then there's more reason for price to go down. However, if let's just say, from 8:39, price makes its way down here. However, once it hits 9 o'clock, let's say this line is 9 o'clock, I want to see all these targets remain intact because after 9, I want to see price push up and then go all the way down. So the most important time frame is in fact 9:30 because that is when the stock market opens up, right? That is when the manipulation happens and the fake move where price typically goes the opposite direction to fake out traders to then head where it wants to go. So I just want to make sure ideally that the liquidity pools remain intact beginning at 9:30. So price already purged this previous high and it entered our liquidity pool, our point of interest. So right now S&P looks a lot more interesting than the Nas, right? And then we'll continue pressing, fast forwarding to see what else happens. So, you know, price takes this level out. So now because I'm bearish after 9:30, I want to see price make the new high of the session. So I would sometimes put array and then I also have some of these options saved right here. So I would mark this out and say waiting for another push above because this liquidity was already taken. And now after 9:30, I want to see after 9:30 for the high of the session to be made. So I would mark this letting me know that I'm waiting for another push higher, right? As for the NAS, you can see the NAS it went up here, but it never came close to our point of interest, and then price is making its way lower. So right now, it's very far away from even getting close to the area that we're interested in. So there's not really much to do or look at the NAS, right? So right now, I'm pretty much focusing all my attention on the S&P. Now, cool. So this next candle, right? This aggressive candle, you can see this is a 9:30 open. So you see all the volatility enters the market. Price not only blasts above this level again, but it completely obliterates this high as well. And it clears out this high and is making its way to take out this high, right? So you're seeing what I'm preaching. You're seeing how we approach the market with a bearish bias, and even with the bearish bias, price is pushing up. This is why market structure alone is not the answer, because people will assume that price going up like this and then going up like this, that price is bullish. But on a higher time frame, we're bearish. And price when it's bearish has a tendency to clear old highs, right? When because we're aware that we're not chasing price trying to take it higher, we're actively seeking to wait for price to break down and give us an entry to go lower. So you can see at 8:30 open, this is the massive move that happens up. Whereas for Nas, you see a wick, you see a doji, right? And you see that this wick clears this liquidity down here. So you can pretty much erase that. And you're beginning to see that Nas by the minute is becoming less attractive because you wanted to see Nas make an aggressive push up to reach our point of interest, but instead it basically had like an indecision candle, up and down, and it cleared the liquidity here, right? And you want, especially after 9:30, you want these targets to remain in place so that there's reason for price to want to go after those targets for you to take partials or for you to hit your take profits, right? So all the signs right now are pointing to me trading the S&P, and I'm taking you guys through this logic step by step because I want you to understand like what's going on in my mind as I'm actively sitting behind the charts, right? Because I want you to learn this for yourself so that you can be an independently thinking trader, right? I want you to be able to operate and do this on your own, right? So right now S&P is giving us everything that we want, right? All of the targets are remaining intact, right? You even have a new target down here, right? That can serve as liquidity, right? everything is working out for the S&P, and right now the Nas is sort of stuck. So now we'll fast forward a little bit more, right? You're seeing another aggressive push up with the S&P, right? So the S&P clear as day, cleared out this high, cleared out this high, right? Like, and it's also tapping into the right, like you're seeing all this. These are fair value gaps. These are bearish fair value gaps. So think about it. Price is bearish. Price goes up and clears these two previous highs, and then it taps into a lot of empty space, which were a bunch of bearish fair value gaps, because price has a tendency to be magnetized towards those fair value gaps, right? To tap it and close those in. So we're seeing all of the confirmations being met, all the signs showing that price is indicating that it wants to go lower because price is operating with a bearish sentiment, right? Now you're looking with Nas, right? Of course, Nas is still nowhere near the point of interest, and Nas is still wicking a lot, and it doesn't even have any sense of direction. Whereas you see S&P is very certain as far as what it wants to do and where it wants to go, right? So let's continue watching. So now, right? So now when I'm seeing this, right, S&P is spiked up. It looked like it was potentially going to give us a bearish fair value gap for an entry. It did not, right? You see this candle clearly close the gap. So there's nothing for us to do. We have to wait for a bearish fair value gap to form in the S&P to take an entry, right? So all of my attention is on the S&P. But if you look at NAS right now, what happened after 9:30 open? Price came up a little bit. It had like an anemic move up, and then you're seeing aggressive bearishness, right? So obviously price left a fair value gap, and normally this would be an entry for a short, right? Because you're not going to miss a gap like this. And price, look how strong these candles are. These are aggressively bearish candles. However, the problem with this, right, price still never reached our point of interest, because for our strategy, the first confirmation we have after we determine higher time frame bias, right, and we mark out the liquidity pool, we need price to attack this liquidity pool first. And price has not done that. It has not even come close, right? Price instead just made a little tiny move up, and then now it is aggressively moving down. So I'm looking at this and I'm thinking to myself, it's unlikely that the Nas ever going to go up here. It's most likely that this is actually the move for Nas, that price is just going to start tanking from this point on. And as a result, right, I'm not interested in the NAS. So this is pretty much, like, I still have the chart side by side, but I'm going to, full screen the S&P because this is what's important now, right? NAS doesn't ever reach the point of interest, so you don't have to worry about it, right? So now I'm basically slowly watching price, right? As you can see, there was an aggressive bearish candle, but then guess what? This next candle filled up the gap. So right now there's no gap, which means there's no entry, there's no trade, right? You have to just sit here and sit on your hands and just watch price. So now you're seeing another aggressive move down. So now, right, I'm getting ready, because if the next candle that forms also leaves a gap, then that's the entry that I take, right? And then boom, you see this third candle was, a bullish candle, but you see a gap clear as day, right? Clear as day. And then on top of that, if you want added confirmation, there is a tiny break of structure, right? We look right here. This low right here was technically broken, pushed down, right? And then you have a gap that was formed, a bearish value gap. Why? We are bearish. So this is what we're looking for, right? So then at this point, I can get rid of this, right? At this point, this is the trade that we have. I put entry right here. Obviously at the bearish value gap, my stop loss at the high, and then where are my targets? My targets are all the way down here, and I drag this all the way down. Well, drag this all the way down to the bottom, right? And the reason why I do this is because we already planned out all of our targets, right? This is what I'm looking for my trade. Now, of course, I'm not going to hold it like the full risk down to the bottom, right? I'm going to take partials along the way. And to me, this is when I start actively planning it out. I take, maybe like 20% at this level, then 30%, then, right? Like, I plan this all out, like the percentages of what I'm going to take off at what point, so that I'm not thinking as I'm going through the process. I'm doing all the thinking in advance. So this is what I have as my setup. So now if we go candle by candle, right, you're seeing boom, right? This candle right here at 943, 944, this is when price taps into this level and we are now entered for a sell. So we're not entered for a sell and price consolidates a little bit. Look how many times price taps into the fair value gap. This is what I'm referring to when I say that the fair value gaps are effectively like magnets. Like fair value gaps, because of this, these are the actual support and resistance zones, right? Most traders trade support and resistance where they see two taps either at the top or at the bottom of an imaginary bar. These fair value gaps are the true support and resistance, because look how many times price is wicking and just rejecting that level, right? Is doing that a lot. So at this point, right, I just have the position open, and then with this aggressive move down, this is when I take my first partial. So this is about, a 1-to-1. So at this point, this is when I close about 20% of my position. And the reason why I do that is because when you're taking a partial, there's only two things that's guaranteed in the market. The first is that you're going to take losses, that's inevitable. And the second is that when you take partials, your account is going to move up. The number that is on the balance is going to go up. So you want to actively take partials, because there's no guarantee that price is ever going to just every single time hit your final target. That's not guaranteed to happen. So here I take a small partial, and the benefit of taking a small partial is that when you take a small partial, not only does your balance increase because you took in some profit, but also if you haven't moved your stop loss to break even because you took off a small partial, you now have reduced your risk and you've made a profit. So even if price reverses against you, it's going to be less of a loss. It's not going to be a full 1 RR loss, right? Because you took partials, and then the partials are going to go against whatever remaining risk you have. So even if price reverses against me, that's only, like, if I were to take a loss, it's only going to be half risk lost. And I'm okay with that, right? Because trading, you want to learn how to mitigate your risk or reduce your risk or eliminate your risk in trading, because that's the most important part, right? So you see one aggressive move down. I didn't roll my stop loss because normally at this point I would move my stop loss to break even, because price, went under this level and it went under this level. Price closed under it, right? It met my confirmations. However, I'm changing that rule because I've noticed now, especially with this past week, that so many times price has a tendency to return back to the fair value gap and, you know, take me out break even prematurely before the actual move. So I've been leaving my stop loss open for that reason now. So as we continue to watch price, you begin to see price going against me, and then boom, right? You see this push up literally wick me out of the position, right? If I put a ray, right, you're seeing price clearly took me out. So at this point, I basically took a half risk loss because I took partial when price reached this level. Now, for most traders, this is the point where they'll give up and they'll say, price took me out. Clearly price wants to go higher because price wasn't supposed to go past this level. So now I'm going to switch my bias to bullish. Well, you'll see that with my strategy, I understand that losses are going to happen, and from time to time price might take me out, but that doesn't necessarily mean that I was wrong, right? If price stops me out, then I can enter another entry. However, I'm going to enter at half risk of my original position, because the point of a second entry is to mitigate the loss that you took from the first entry, right? And you're practicing good habits because you're entering in half risk. So if you lose that second trade, it's okay. It won't be the end of the world, right? So I was stopped out, but that's okay because I didn't give up. Because if price stops you out, but it still meets all of your confirmations again, then you are allowed to enter the trade again. So that's exactly what I did. So I was stopped out by a pip or two. And then I see an aggressive move down. So now I'm on high alert in case there's an entry. And as you can see, price left a gap right here. And then it also had another bearish candle. So initially, I was going to, when I was setting this up, I was initially going to have my entry be right here. However, as I allowed price to play out a little bit longer, right, I tend to check the different time frames. And as I looked on the 2-minute time frame, I noticed that this gap was bigger, right? And so I wanted to settle with this gap. And the reason why I did that is because what you need to understand is, like, this is a fair value gap up here, but it is less likely for price to make its way up into that gap, because of course this gap is deeper of a retracement than this gap, right? This gap is obviously going to more likely to be hit than this gap up here. So if the risk to reward still works and still makes sense, then you can still take the other gap because it still meets your confirmation, right? You want to enter on a fair value gap, and this is a much bigger fair value gap than this tiny fair value gap right here, right? So that's what I was looking for. I was looking at the entry on the 2 minute time frame, right? So we're already seeing, and I'll get rid of this right here. We're still seeing that our confirmations are still being met. Like this is still a legitimate setup, even if we took a loss. So now I have my stop loss here, right? I mean, sorry, I have my entry right here, stop loss above the high again, and then where are my targets, right? I drag it all the way to the bottom, right? For a total 1 to 5.44 risk to reward total. And once again, we're not taking it full risk or full position all the way down. We're taking partial along the way. So this is what I started looking at, and this is what I had set up. So now I'm just being patient, right? I have my limit order set. I'm just being patient. So now, boom, you can see price taps us in at 10.10. We have now entered our position. So then at this point, right, here it is. I have moved my new target to be down here, right? Because obviously this liquidity was already taken. So now my new target is down here, and this is a 1 to 1.56. So I'm perfectly content with taking, you know, um, like 20% at this level, and then closing at least 50% of my entire position by the time I get here, and then maybe closing, you know, an extra 20% to have 70% close, and then an extra 5-10%, and then 5-10%, right? You guys get the idea, right? That is how you want to begin trading, because there's no guarantee you're going to get to the bottom. So as price continue to make its way lower, 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 that's when you continue taking partials and partials and partials off until you make it to the end, right? So price taps us in, then you're seeing a small candle, and then another candle right here. And so we're just in a little bit of, you know, like a drawdown, right? Then you see a little candle, and then boom, this was the mega candle. So while this was all happening in real time, I was basically organizing my trade. So, you know, it tapped me in at 11, at 10:11. So while this was all happening, I was planning on my trade, right? I was doing the calculations on the percentage that I was going to take off at this level, you know, like a 20%. Then I was going to take off another like 30% to be at, you know, to close 50% of my position here. And while this was all happening, price made this aggressive move down. This was all happened in a matter of seconds, right? Price out of nowhere, it just shot down. And I thought it was some sort of glitch. I thought it was something that just happened, right? Then I looked in Forex Factory, and I saw that it was, you know, news that came out with Trump and Iran. And of course, news is the excuse, right? So that was the excuse to like completely pump price like this. So once I seen this move, of course, I was panic closing most of my position, right? Because price slashed through this target here and slashed through this target here, and also tapped into the fair value gap. So if I were to bring out the fib tool, right, from this low, which is the final target, all the way to this high, you're seeing that the price came down and went past 70% of the entire move. So as a result, I was perfectly fine with closing out, you know, at this point I closed out 80% of my position, and I only had runners to go to, you know, this level here and then this level here for the final target. And at that point I moved my stop loss to break even, because the difference between this trading day and one of the trading days from last week was that I moved my stop loss to break even early, you know, when I only closed maybe 20% of my position, right? This time, like 2/3, almost 3/4 of the entire move happened instantly, and I already closed the majority of my position, so I wasn't too concerned, right? So I moved my stop loss. At this point, it's break even. Now, as you eventually find out, right, price came and then it wicked me out at this point, right? It hit me at our break even. Now, the funny thing is, of course, like I've been mentioning all of last week, that I've noticed that price has a tendency to get magnetized back towards this fair value gap, right? Because this is the true support and resistance in the market. So price came up, taps it one more time, and then you're going to see after that price takes off, right? So price gets close again, right? And it doesn't tap it, right? As you can see, right? Like this high clearly doesn't tap this level here. And usually when I move to break even, I usually put it exactly at break even to give myself as much room to not get wicked out. So price wouldn't have wicked you out here. And then as you can see, price continues to travel slowly, 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 right? As it makes its way lower. And then as you can see, might take a little bit of time. Let me just put on the 2 minute time frame, just kind of double the speed. Right, as you can see, price came and it actually tapped this level perfectly to the T. It went past it by a pipette, but then you eventually see that if you just waited a little bit longer, um, yada yada, boom, you'll see that price did in fact blast through the final target. So this is important to highlight because first and foremost, right, the first lesson that I wanted to share with you guys is determining higher time frame bias. And I know that I mentioned previously that I use both pairs to help me trade, right? Like whichever pair has the most recent break of structure in the higher time frame, right? The most recent prior to 8:30, that's what I use and that's what I stick with, because I know there's going to be some traders that would have gone long because they were expecting price to be bullish on this day, but price was in fact bearish. And remember, if you remember at the beginning of the video, S&P, right, that the S&P was in fact bullish based on market structure because there was no structure break on the S&P yet to go bearish. So many traders would have approached this day being bullish even though it was in fact bearish. So notice how me using the NAS and the price action that I seen on NAS for market structure is what allowed me to be bearish on this day and what allowed me to catch this trade. Now once again, I'm gonna highlight again, right? I was stopped out at break even at this point because I saw that aggressive 1 minute bearish candle that made me panic close most of my position. And I also didn't want to, potentially run into the small chance that like another unexpected massive news event was going to happen. So I figured let me just, roll my stop loss to break even to protect my account, right, and not, you know, take another loss. I already closed out most of my position, so if I get stopped out, it's okay. It's only like a 20% runner was left. But as you can see, right, after I get taken out, I break even, price just begins making its way down, and then it does in fact take out this target right here and the final target that we had. So here we are. Like I said, there's gonna be some people who say this was all hindsight. That is easy to say in hindsight. It's easy to look back and say price would have done this and price would have went there, blah blah blah. But here we have the executions, right? Here we have, as you can see at this candle, right? Actually, we're going to 1 minute time frame. Let me go back. I know it's a lot of lines, guys, but hopefully this session has been very helpful, right? So as you can see, um, right, this fair value gap was the one I mentioned where I said I took a short, right, and I short on this candle, the first candle to tap into fair value gap. You can see I took a small partial right here, right, small partial was taken right here after this low was taken, and then price goes against me, and obviously you see that it shows the blue candle right there because I mean the blue arrow because it's telling me that I got stopped out. So my sell position got closed right there. Then right when there was the break of structure and the fair value gap, right, the same fair value gap on 2 minute, I entered right here, right, the very first or first few candles, um entered for a short, right? Obviously you have the red arrow down and then price aggressively pushed down. So at this point, right, you're seeing most of the position get closed with this long bearish candle. Like of course I couldn't catch at the very bottom of the wick, right? The wick pushed up, so I kind of caught it like around this level here. um and then you see that at this uh bullish candle right here, this is what wicked me out at break even. And then of course you see that price eventually proceeds to absolutely belt and hit the final target, right? And if we go on the 2 minute time frame, sorry, so many times at the return, right? If we go back on a 2 minute time frame, see that price goes all the way down and then it clears the final target right there. So I'm just showing you guys this as all proof to let you guys know that this is what I'm doing. This is in fact what's happening, and I'm trading this real time. This is not me just going back and with the power of magic being able to say, oh yeah, or just, blowing smoke and just saying, yeah, like this is what you do and then this is how you be successful. I'm showing you that I'm taking these execution, and I'm showing you that, you know, that many of these, like, I guess you could say these mega setups, these mega trades that were supposed to play out in my favor, that in the last like 2 weeks or pretty much almost a week time, that I basically got stopped out like 2 or 3 times at break even before the actual massive move happened. Now this was a special case because I already closed off like 80% of my position, and this was an unexpected large news event, right? This all happened in a minute where price just like completely melted, and I didn't want any sort of whiplash to like, take me out and have me take a loss because of slippage and things like that, right? So that's why I protected my position. But if I waited until 11, because this is the candle, these are the two candles that basically formed at 11 o'clock. So if I waited till the end of the session to move my stop loss to break even at 11, of course this candle wouldn't have wicked me out, and then I would have been able to ride the wave all the way down to the final target. So once again, of course, learning moment for myself, but hopefully this was very insightful and a learning lesson for you, to show you guys this is what's happening, that this is the game in the marketplace. This is why market structure alone is not going to allow you, excuse me, to succeed or win in this market. Because once again, if you think about it, right, and let me show you this example right here. Price was going down, 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 right? You can see price was doing a little bit of this, right? Then price goes up here, and then it goes higher. So most people who trade market structure are going to say, okay, price has to be bullish. So then they'll probably try to take some sort of entry right around here, right? Because they're expecting this low to maintain, because market structure is saying that this low is supposed to remain intact. So they'll probably take an entry somewhere around this level here, and then they'll try to target this high, right? They'll do something like this, like a low stop loss here and then above these highs. But then what happens? They would eventually get stopped out at this level. So then you know, some traders will say, okay, well, market structure broke, right? Because this level now went under this level. So now price has to be bearish. So then, traders would take a sell here, and then they would get stopped out. And then they'll say, okay, well, I got stopped out again. So now price has to be bullish because price went above an old high, and that means that it's bullish. So then what would they do? They would take a buy over here, and then they obviously would get stopped out because they're trading on the wrong side of the market. This is why it is important to figure out higher time frame bias, because if you can't determine the bias, you're better off just not even trading. Or if you are going to trade for whatever reason, trade with reduced risk, because you don't know which way the market is going to go, right? Every single time I step behind the charts to trade, I am clear on my mind with the bias, and I stick with the bias for that entire session. And just like I showed you, I use the S&P on the 1 hour time frame to determine my higher time frame bias, and I approach the S&P chart with that same bias. Even though technically speaking it never broke structure to the downside on the 1 hour time frame, I still use it because that was the most recent structure break, because I know that the S&P and the Nas tend to move in tandem. They typically like to do very similar things. And so if one pair is showing me that it wants a willingness to go higher, then I'm going to expect both pairs to want to go higher. And the same if it wants to go lower, right? Price showed us that it wanted to go lower on the 1 hour time frame, on the higher time frame for the Nas. So I approached this day bearish. And as you can see, this is the power of the strategy, because one thing that was never fully highlighted and made crystal clear to me was the fact that, like, look at the entry that I took. I took the entry at the peak of the move. Like this, guys, this is the high of the session. This is the high of the New York session. I took a short at the top, at the very top, right? My stop loss above here, my entry up here. I took it at the top, the peak of New York session, and look where price, look at everything price did. Price just, I mean, there was some consolidation, but price eventually just began tanking down lower, right? This is why this is the most powerful strategy. Nothing comes close. Nothing, like there's nothing that could compare, because I am trading in alignment with the market, because I am trading the market. This is what the market is doing. The market is attacking liquidity and then pushing price the way it wants to go, right? Price is bearish, right? Clear as day, right? We see based on all this evidence that price was in fact bearish for the day. What did price do at the beginning of 9:30? Because this was 9:30 opening. What did price do? Price went up, right? So for most traders, they'll see this aggressive move up and they'll chase it and think, oh, price is gonna go up, price is gonna keep going up, price is bullish, because look at all this bullish momentum, look at all this buying pressure. No buying pressure, right? Price came up because it wanted to take liquidity. It's after orders. It wants to activate orders. It wants traders to enter for buy, 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 buy. It wants to activate all these buy limits. These buy stops, that were set up here by these large institutions. Why? Because when it activates these buy stops, these buy orders, and as traders see price move up, they're going to be buying. So the market is going to be flooded with buy orders, which is the perfect counterpart for the market to then sell, right? So because the market wanted to go lower and wanted to go lower all the way down here. And what was lower? This low, this low, a gap right here, this low, this aggressive wick from the day before, right? These are all targets. Like, guys, I'm doing this because I care. This is why my videos are so long, and there's gonna be people out there that are gonna complain about the length of my video. Joel, you should have 5-minute videos, 7-minute videos. I do this because I want to give you all the details so that it can begin making sense, because I understand how long it took me. It took me 6 years, 6 long years for this to begin making sense and for this to all click. And so I'm doing this because I care, because I want you to succeed, to be able to do this on your own, to be able to catch moves like this. Because there's a lot of traders who say they're traders that they'll just trade and they'll just trade a one-to-one. Sure, if you're profitable, that's good, right? More power to you if you can succeed, right? Because not many traders even succeed in this industry. But there's a whole new level of trading and a whole new like pinnacle to reach when you're able to catch a move at the very top, at the peak of when it's happening, and then being able to ride the wave all the way down, to be able to take price this far down. Because then one win like this, one trading day like this, one successful win that you can have like this will erase all the losses. If you've taken losses early in the week, this alone will erase all your losses and put you in profit. Now, imagine if you now also have a high win rate and you're taking trades like this normal, like this is a normal day for you, a consistent day, right? If you're able to do trades like this over and over and over, how can you not be profitable, right? Only taking 1 to 2 trades a day. How can you blow an account if you're practicing proper risk management? You're not going to be blowing accounts. You're not going to be, right? And your strategy, you're only allowed to take certain types of trades because of the strategy, right? My strategy only offered me 2 setups for the day, and they played out, right? First one I took a minor loss, right? Half risk loss. Okay, entered half risk, and then look at this massive move that played out, that erased my loss and put me in profit, right? This is the power with the strategy. So that wraps up the video. That wraps up the video. If you enjoyed the video, do leave a like and subscribe as we're on the road to me subscriber, guys. So once again, it's Joel, and I'm out. I'll see you guys for the next video.